A very warm and a cheerful morning to all our viewers. I, Pooja Bisht, welcome you all to this webinar organized by KCC Institutes on 3 mega trends shaping the financial service industry. To understand how this sector is reeling under the current scenario and what is the whole process of reshaping our financial service industry to cater to the new normal demands, we have with us Mr. Faraz Ahmad Sir, banking expert, Mckinsey and Company from London, and Mr. Debopriyo Bhattacharyya Sir, banking expert, Mckinsey and Company from Delhi. I extend a cordial welcome to both. Now, I request our director, Dr. Professor Bhavna Agarwal ma'am, to present and introduce our speakers for the day, Mr. Faraz Ahmad Sir and Mr. Debopriyo Bhattacharya Sir. Ma'am.
Thank you, Pooja. Good afternoon, everyone. I extend warm welcome to all of you in this webinar, 3 Megatrends Shaping the Financial Service Industry. I find immense pleasure to introduce our key speakers of today, Mr. Faraz Ahmad and Mr. Debopriyo Bhattacharya ji, who have kindly consented to share their views on this topic. Rapidly advancing technologies, evolving customer expectations, and changing regulatory landscape all are opening doors to disruptive innovation in financial services. From cryptocurrencies to big data to peer-to-peer lending, fintech innovations have captured the attention and imagination of customers, investors, and incumbents. However, the nature and extent of the impact that these innovations will have on the financial service industry remains unclear. This webinar will discuss the various issues and factors that have the potential to transform the financial ecosystem, as well as the risks and opportunities that could emerge from changes in the way financial services are structured, delivered, and consumed in the future. Today, we have with us Mr. Faraz Ahmad, banking expert in Mckinsey, London office. He has experienced more than 10 years in the field of financial services, having core experience of advising financial services institution on strategy, marketing, sizing, and innovation. Mr. Debopriyo Bhattacharya Sir, banking expert in Mckinsey, Delhi office. His domain is in advising financial services institutions on capital innovation, global networks, and innovation. I extend a cordial welcome to both of them.
Thank you.
Now I request Mr. Faraz to please.
Absolutely. I think there was. Can you hear me clearly, though? Because I'm not sure if the internet is working fine.
Yes, sir, you're audible, sir.
Perfect. Thank you. Thank you, Bhavna ma'am, and thank you everyone for this wonderful introduction. I think what Debo and I plan to do over the course of the next few minutes is discuss 3 mega trends that in our opinion, so we aren't really representing any organization, but that in the 3 mega trends that in our opinion are going to shape the financial services industry for the next few decades. Before we jump into what we think those 3 mega trends would be, I think it is wise to spend a few minutes on what banks are, what is financial services, and how we got it. So I'm just going to take it very quickly through the journey of financial intermediation. And we're going to start all the way back to about 8 or 9,000 BC, which is where agriculture was the next big innovation. The history of money and financial services is very closely tied to the history of writing. So I think there is some disturbance. I'm just going to ask you this language. Thank you. So essentially, the history of financial services is very closely tied to the history of writing. About 8 or 9,000 years ago, when agriculture had become big, there was a natural need to take stock of grain, to find out how much grain was produced. As a result, somewhere in former Babylon, I think somewhere near Sumer, I'm not sure, writing was discovered. It was purely an accounting method to identify how much grain had been produced. As time progressed, about 3000 BC, That is where very early banks were formed, because there was a new problem which was coming up, that sometimes people produce a lot and they don't know where to store it, and sometimes people produce nothing and they don't know where to take it from. An intermediary body was set up in the middle, whose primary job was to take excess grain, and then if someone needed it, to really give it to them as a form of an early loan. And this is really the beginnings of it were somewhere in Babylon and somewhere in India, and so in a way we are financial pioneers, and this established what we would later become banking. We move ahead in time around 1000 BC. That's when grain start moving away and giving way to copper coin. Somewhere in China, is what everyone believes, the first use of money in form of copper coin has started. And that continued, and it took over all over the world till about 800 AD, when there was a copper shortage in China, and naturally, then they realized that they still must use money, and then they moved to banknotes. And this is literally what we essentially use right now. From 800 AD in China, banknotes reached Europe 1600 AD, and from there reached the entire world. In the middle of all of it, and very close to when banknotes were being used, around 14th or the 15th century in Italy, the modern banking system was being set up. And what I mean by the modern banking system is an institution which where people are depositing their money for savings, and that institution is using people's savings to give credit to someone who needs it. The core purpose of this institution is really to take risk on behalf of people, and to further credit. So this is in 14th century Italy. The financial system was being set up. The modern banking system was being set up. Right now, we have one bank, Banco Pasta di Siena in Italy, which is the last remaining bank of one of the oldest banks which was formed. It was formed around the same time. I think it was early 14th century or 13th century, and this bank was formed. It still exists and it's still functioning to the day. Now there is a fundamental purpose that financial services industry, the financial services companies perform, and they have a fundamental importance to society, and that is scaling up innovation. In the moment the modern banking sector was set up in the 14th and 15th century, any innovation that happened after that, uh, be it railways, be it the steam engine, telecommunications, or electricity at the end of the 19th century. So any innovation that happened after that very quickly scaled up. Because the people who innovated that had access to modern banking facilities, they had access to credit, so they could take a loan and build a big business around it, thereby allowing Thomas Edison to turn his invention into a reality for every household in America then, and now every household in the world. And this was the difference, because there were some inventions which used to happen before the banking sector was established. In 900 AD and 1000 AD, we invented gunpowder. Around the same time, we invented printing, but none of it took the world at a storm, like the same way that innovations of the 18th and 19th century did. And the difference was the lack of the financial sector to really provide leverage, from growing it to one wonderful invention to a completely changing industry. That brings us to modern financial innovations. In the arena of innovations moved away from China to the US now. In the 1960s, we had credit card. There was a New York-based company called American Diner, which wanted to create a group of exclusive dining cards where its members could go and dine in wonderful restaurants. So it identified all the rich people of New York, got them together, gave them cards. And then later realized that this is a wonderful way of giving them some loans as well if they have that card. And that's how credit cards were established. In the 70s, we had ATMs. In the 1980s, we had what I call more modern financial innovations, such as the mortgage bond, such as other securities, which fundamentally allowed lending to increase and new industries like investment banking to really flourish. We moved to the early 2000s when you had digital banks taking shape, something which is one of the at the forefront of innovation right now. And really, then in 2008 or 9, the last major financial innovation, which was cryptocurrency. So we moved away completely from an early bank whose job was to take some grains and give grains to people to an internet-based cryptocurrency right now, which will be very important in the years to come. It is not right now. At that note, we have a few slides which would help us navigate through the three megatrends that we think are shaping this industry right now. I think my screen sharing is disabled, so if someone could enable my screen sharing, please.
Sir, I'll just enable it for you.
Thank you.
So you can go ahead.
Thank you. Let me know if I think you guys can see my screen now, no?
Yes, sir, it's visible.
Thank you. And as a reminder, and as a, so just let's do a reminder to those of us who don't know banking, and that would be naturally many of us. A bank's primary function in the economy is very simple. It needs to give people who want to save money a safe space and a financial asset. If I want to save money, I need to go to a place that should give me some interest on the money that I'm saving, and it should be a safe space. So I have savings, I go to a place, and that place becomes a bank. At the same time, there are a bunch of people who want a loan. It could be companies who need a loan to finance a big project. It could be people who need a loan to buy a house, to buy a car. So there is demand for credit in the economy, and there is demand for savings in the economy. Bank is an institution which sits in the middle of all of it and tries to match this demand. That is its core purpose. Everything else it does outside of it is very ancillary. Money on this core purpose is by charging an interest to people who borrow, or charging a fee from anyone who wants to transact with it. And actually, that is really what fundamentally is a revenue stream of banks. Currently, it is still, the financial services sector is still the biggest industry in the world. The numbers that you have right now on your screen, they're old, they're 2018. But financial services, by and large, in terms of operating profit, is still the biggest industry in the world. It has over $1 trillion of operating profit. This is banking, asset management, insurance, banking and asset management combined. The other industries, which is be it technology, consumer goods, basic materials, or as big as they may be, they're still smaller. So for the world economy, the standard enabling industry that is banking is still its biggest. However, currently there are several disruptive megatrends that are staring this industry at its face. An example that I heard from one of my colleagues at Mckinsey, but I still like to share with most people, is at the turn of the decade in 2010 to 2020, essentially this decade, banking is extremely similar to the transportation industry of the 1890s. We know that something is broken in the system. What I mean by that is we know that banks aren't making the same amount of money that they were. So the finances of banks, the math is not as attractive as it were 10 years ago or 15 years ago. The social purpose of banks, which is reach out for savings and credit to as many underbanked people, could be better. Banks credit, but it could be better. And there are new lending needs which have emerged. One example being student debt in the US. So there are very new lending needs which have emerged, which banking isn't addressing with its full fury. So it's an industry which is still stuck in an early digital age. And that's why I draw the comparison to transportation industry in the 1890s. In the 1890s, transportation was grappling with this big problem. The transportation industry essentially comprised of two things. You make a wonderful carriage and you get a very good horse. You combine the two, and it's a good transportation vehicle essentially that you can sell. The business leaders wanted to buy the best horses. They wanted to get the most comfortable carriages. This led to a pollution problem, and the pollution problem being uh, mountains of horse dung being I wouldn't say stored, but really lying around the entire around big cities of the world at that time, New York, London, and all the other big cities. And in the 1890s, when blue sea prophecies started coming to mainstream culture, that if nothing else changes by 1930, there would be a 20-foot pile of dung in London, and similar in New York. This is the time when everyone was looking for a clean solution. They went with multiple options. Horses would be taken outside the city. Horse dung would be cleaned regularly. You would have horses who didn't essentially need to shit, and pardon my French here, but who didn't essentially need to shit regularly. So there were all sorts of minor things that people were trying. Somewhere in the US, in the heartland, Henry Ford built a car, and it changed the transportation industry forever. And it is at a and banking currently, we believe, is at a similar transformation path. There are minor things that are being improved in forms of cost improvements, better products coming in, but the industry is in need of a fundamental shock, which would essentially transform the business model like it did for transportation. Having horses and carriages were no longer important. Owning a car or having the capability of producing the car was important. There are three big trends which can point towards this transition. Now, figuring these transitions out in hindsight is always very simple. You can look at the last 30 years and you can be like, okay, this was the absolute way this change would have happened. Guessing it is always difficult, and forward looking is always difficult. Uh, in fact, accurately guessing it for the next 2 to 3 years is near impossible. That's why Debo and I decided to easy task, and we thought we wouldn't speak about the next 2 to 3 years. We're only going to speak about the next 10 to 15 years, and we're really going to look at the system as a whole and figure out what we think could drive big changes in the next 10 to 15 years or 20 years. So what we would be describing is a financial services institution in the year, let's say, 2030. And what are the big changes that would make? There are three big mega trends that are likely to shape the future of the financial services sector. One of them, of course, surprise, is digital disruption. But later on, we will just dive a little bit into what do we mean by digital disruption. So the first big mega trend is digital disruption, and it is the same as everyone understands it. Every industry is going digital. Why shouldn't banking go digital? The second one is a little more technical, and it's related to macroeconomic realities. In the last 10 to 15 years, there are two big changes that have taken place in the fundamental economics of the world. The interest rates are at an all-time, I think, 100-year low. So this is the lowest they've ever been in the history of the modern banking sector. And after 300 to 400 years, power is moving eastwards again. You see the rise of China, India, Southeast Asia, Japan. From about 1750 till 2000, all of these countries contributed to, I don't know, 5 to 10% of world's GDP. And if I remove Japan, it's probably nothing of world's GDP. Historically, they contributed to around half of world's GDP, perhaps even more. And there is a trend by GDP, be it by levels of GDP, or where the biggest banks are coming from, or where the biggest companies are coming from, that global economics and commerce is moving eastwards. As a result, global banks, which want to finance that economic and commerce, are likely to move eastwards as well. So that would be the second big mega trend that we will discuss. The third big mega trend is emergence of ecosystems, which is something that has become a reality for the first time, I think, in the last 10 to 15 years. And I wouldn't describe what ecosystems are right now, but what we want to discuss here is when industries' boundaries blur, when banking enters entertainment and then enters telecom and then enters housing, or vice versa, when a like enters entertainment and then enters banking, what would this new industry look like? The fourth one is I think a couple of minutes on on the current crisis and roles banks can play here, and what does it actually mean to banking. But this is really a short-term trend, and what is it that is like expected in the next 1 or 2 years. Let me move to the first one, which is digital disruption. I think it's very famous quote that we always overestimate the changes that we think will happen in the next 2 years. We always assume that the next 2 years is going to be fundamentally, we're going to come up with the best phone, internet is going to be great, every industry will change, and then we pass on year and year, and we see those expectations. But we always underestimate the changes that we think will happen in the next 10 to 15 years. And right now, we are only going to focus on changes that will happen in the next 10 to 15 years. And again, at this stage, it is Debo's personal opinion, my personal opinion. We try to guess based on what we have learned, we have told, we have felt in the industry, but we are really talking about something that will happen in 2030. We can't obviously be 100% right. Uh, Now, I think it is common knowledge that most industries are, and it's also common observation that most industries are fundamentally being disrupted by digital businesses or digital ways of doing things. One example, of course, that everyone's aware of is entertainment. The way we used to watch TV 5 years ago is so fundamentally different from the way we watch TV right now. Perhaps in 3 to 4 years' time, the subscriptions to large cable networks, if they don't change, would drop dramatically. And at the same time, the need for high-speed internet and the need for paying money to Netflix will increase dramatically as well. So most industries are passing through this. Some are at a very advanced stage of it, like telephones were and computers were. And some are at a very nascent stage and have barely begun, like construction. Banking is somewhere in the middle. So banking is going through digital transformation, but if you visit a bank, and especially if you visit a bank in India, and in fact in many countries in the world, you would also feel like the parts of the process are still stuck in the 90s. Uh, they do use computers, but it hasn't become the Netflix like service we would want it to become. And this particular fact is true for banks all over the world. So before we figure out what is it that banks can become when there is digital transformation, let's understand why is digital transformation so important right now, and what is it for financial services, and what is it that's driving uh, this last 200 years. And sorry, there are three things that are driving it: new technologies, new regulations, and a change in customers. This new kind of customer who's coming on. In terms of new technology, for the last 200 years, that has been the fastest growing time for technology ever in human history. Perhaps faster than Greece in 200 BC, and faster than any time that we've experienced. We started with 1800s with the telegram. Moved to 1900s, we moved the telephone. It took a while to get all over the world, but suddenly by 1970s and 80s, we were living in a world where information could reach any other part of the world in a day or in real time if it's big cities and then they want to speak. No longer would there be a lag in information. In the 18, I used to read this in history. In the 1700s and 1800s, a bunch of big kings used to subscribe to French newspapers, and they would receive that news 3 weeks later or 4 weeks later, and that would still make them smart because they were still the first people in their kingdom to get to know what's happened in France, what's happening with the revolution, what is this new technology of steam engine that people have discovered. But on an average, it was really months later, and the regular people living there could perhaps not even discover it for 5 to 10 years, if at all. That's really unthinkable right now. Since 1900, information being passed around the world has transformed how we are. No longer can there be information bubbles. There cannot be a country which possesses some advanced information that the world doesn't get to know. It might take years to adopt it, but we always get to know. The next big thing that happened in terms of, I've skipped television here because it's less important for banking, although it's quite important for the world. But the next big thing that happens for financial services is in the 1990s. That's when information from audio also becomes audio visual. That's when you have mobile phones and internet. And a part that I've skipped here is computing power. The moment you get mobile phones, internet, and computing power, not smartphones yet, banking as a business starts, and it happens in a very simple way. If you have better computing power, you can process more data, and you can understand people's risk, payment methods slightly better. You also get access to something called an Excel sheet, which becomes, as stupid as it may sound, which becomes one of the big reasons for the rise of investment banking. The moment you start building Excel models, you can have access to information that people outside of those Excel models cannot interpret or cannot infer. That gives you an advantage in trading, and as a result, the need for having better Excel model increases and becomes a very important driving force in investment banking. But the real big change, banking is still the same. You still have a branch, you still have people, you still have tellers giving you cash, you still have a full loan process form. However, they're all smarter now. They can call each other since the 1900s. They can also compute your numbers better now that they have access to a computer. Then you reach around 2010, which is where a smartphone comes into play. And big data comes into play in the last 4 years. And the combined power of that means that everyone really has access to information which is audio, visual, and real time. It's not same day anymore, it's real time. So everyone has access to information real time at all points of time. Maybe news, this may be data, this may be other information, but everyone has access to it. And everyone's data of doing whatever that they're doing starts being recorded. Don't mean it in a scary way. I mean, if we purchase something, someone has our purchasing history. If I go to a store, someone knows I went to a store. Maybe my mobile phone knows. Maybe my credit card company knows. But someone knows, which means that my financial transactions data profile can be visible. What that means is if every day I'm regularly ordering pizzas after that, and my credit card company knows that, it can also tell my insurance company that listen, ask him to follow doctor's rule. So there is inferences that can be made based on data. Those inferences can be done automatically. They can be done to my advantage. Basic technology fundamentally evolved in the last 10 years. Regulations, which is our second point, also fundamentally evolved in the last 10 years. And I wouldn't get into the details of regulations, but the spirit of regulations around the world has been the same. They want to make the financial services sector more resilient, safer. And the way you make them safer is to ask them to hold more capital, which usually translated means that you really slow down on the profit and you curtail the return. So while technology is evolving, the costs of the current model are being reduced, and rightfully so to. At the same time, competition and any regulation that encourages new entrants is being encouraged. In Europe, it's called open banking. In India, 5-6 years ago, we gave more banking licenses to people to different banks. So everywhere around the world, you're encouraging more players to enter. Profits have been reduced. Technology is evolving. And the third pillar to this is a generational shift which is happening. Sometime in this decade, I don't know, I think it was 2 years ago, 3 years ago, but sometime in this decade, the actual population of millennials in the world increased from and especially in the US and the developed world, increased more than the population of baby boomers. Baby boomers were these growth generations. This is the post-war generation for everyone born between 1950 to 1975. This generation fueled with modern economic growth, and they were really the engines of it. Uh, the values of this generation, it's a very American term, so I'll give a very American example. Save enough money, buy a mortgage. Own a big house, save enough money, give it in a bank. Don't spend on things that you don't need, but definitely get a big house and save enough money. Those were two fundamental pillars of it. As a result, most baby boomers own big houses, and most baby boomers have a large part of wealth stored in banks. Millennials, on the other hand, while they grew in peacetime, they grew in economic crisis. Millennials is anyone born after 1981. I think it changes country by country, but it's really anyone born after. They grew up facing economic crisis. First, the dot-com bubble of '99, then the global financial crisis of 2007. They also grew up at a time where college education had become prohibitively expensive, especially in the Western world. So, and they grew up at a time where they had access to internet and in other aspects of their life. So, because of financial crisis, they could never have jobs which allowed them to save a lot. Because of education becoming very expensive, they always had student loans that they had to pay. American students have $1 trillion of student loans. That's bigger than the Indian housing market, I think, twice bigger than the Indian housing market. So they always had a lot of student debt that they had to pay. They could never get jobs that their predecessors could in terms of earning wealth, and they were used to very real-time decisions and data simply because they lived in the time of internet. As a result, it started showing in their financial demands. Uh, they're less concerned with mortgages because they can't afford a house in New York. They're more concerned with paying their student loans. They're less concerned with accumulating savings in the form of term deposits because they don't earn enough yet. They're more concerned with instant payments. That if I buy something, I shouldn't even take out my credit card. I should tap my phone and walk out, or it's paid. Or I should just shake someone's hand and it's paid. There shouldn't be a delay in the service of me writing a check, reaching out to my wallet. They were also used to very top-notch services in other industries, which they didn't see in banking. As a result, uh, the digitally banking changed. You had three you had different kinds of fintech entrants, and I just want to give examples of very simple examples of three fintech entrants, which occupied different spaces here. The first one is Monzo. It's New Age Bank. Uh, it's a UK-based bank, and it's built around one very simple premise. It takes someone in the UK around 3 to 5 days, or used to take someone in the UK around 3 to 5 days to open a bank account. It required a bunch of paperwork. You needed to get an appointment, go to the bank, and it was a longer process. While you can do almost anything, you can get a Netflix account, Amazon account instantly. What Monzo did was it asked you to click a picture of your address, record a video of you saying you want a Monzo account, and that was it. You got a Monzo account. 2 days later, you put the card. It became an instant hit, and this is very recent, maybe before early 2010, 12 or 13. It became an instant hit. Young people in the UK lapped it up, and such businesses have spread all over Europe and I think US as well. The second example of how disintermediation or digital disruption is taking place is through Paytm, which is in some ways a pioneer in payments. Banks are doing many things well. They're very good at giving out large chunks of loan. If you ever want a house, you will go to a bank. If you're running a company and you want a loan, you will go to a bank. Banks didn't keep up in time with payments. This credit cards and debit cards were extremely new payment arenas for the 90s, and they're not extremely new for 2010. The need to integrate your payments with digital purchases is extremely strong. You cannot go and enter OTPs after OTP. You have to buy, I don't know, a month, and you have to enter 5 OTPs. I understand the need for keeping the card secure, but this was also leading to a very long waiting time in order for people to buy a simple thing. As a result, a player like Paytm occupied a space in the middle where it was simply click a button. You have some money in that wallet. You click a button and it's free. The third example in this case is Lending Club. It doesn't. It does. It's not Paytm. It's not. It's not a digital bank like Mojo. Lending Club follows a very simple principle. Uh, if there is a lot of data available on everyone, and if there is real-time data, Lending Club can decide uh, who is a good customer and who's not a good customer, in the sense who will pay back and who will not pay back. So it sits in the middle of an industry called peer-to-peer lending, in which case The traditional banking system worked in a way that if I had money, I would save it in a bank and the bank would lend it out to whoever it wants to. Lending club connects people who want to borrow money and connects people who want to save money. So if I have some, if they have some money and I want to borrow some money, both of us would go. We would be different parties to lending club. We would go there. Lending club would tell Debo that listen, Faraz wants to borrow, and I know you have money. Why don't you give him 1,000 rupees and he'll borrow? And lending club would assume some responsibility for it. That we know Faraz here is the data, he's fine. But in case he doesn't pay back Debo, it's also yours. As a result, it gives Debo better returns, and as a result, for me, it gives me a loan maybe when a bank wouldn't. And this is establishing a new sub-industry in banking called peer-to-peer. There are multiple such disruptions happening in banking and will continue to happen, but I just wanted us to focus on these few right now. With this, I pass it over to Debo, who can speak about the macroeconomic changes and ecosystems.
Thank you so much. Thank you so much, Faraz. Yes. Um, Faraz, can we go to the first link if possible? So friends, talking about interest rate and banking margins, what is an interest rate and how do banks make money? As Faraz was saying, banks are in a very simple business of being a broker or a mediator of public money. What it means is if banks receive deposits from you, they give it out as loans. And now in between, banks make some margin, which is basically banks' net interest margin or the income that banks make. Of course, banks have a plethora of new and other services, fee-based services, advisory, investment banking, etc., etc. However, the basic business of banking historically started as the intermediator of flow of money from a source which has higher money than it needs to a sink which needs more money to do business or for consumption. As I was saying, banks make a margin in between this taking money and giving money business. That is basically determined by existing interest rates. What it means is this is basically the cost at which the money is available to a bank, or of course also it is also interlinked to the cost at which the money is available to the user as well, the end user. Now let's say you want to buy a house. If I offer you a 15% interest rate and another bank offers you a 7% interest rate, of course you would go to the bank that offers a lower interest rate. Very simple, plain and simple. Why? Because for a lower interest rate, you would have lesser amount of interest accrued on your borrowing, and you would have to pay lesser amount of EMIs as we call it. What it means is lower is the interest rate, lesser is the spread or intermediate money that bank is making from that fund transaction. Historically, if you look at this chart, which Faraz is showing, the interest rates of global financial system has gone down significantly in the last 40 to 50 years. I would specifically look from post World War when it increased due to high inflation, macroeconomic uncertainty, etc., etc. However, in the last 20, 30, 40 years, you have seen a significant drop in the interest rates. There are two reasons behind that. As Faraz was saying, technology has evolved. Now, as a customer, it is easier for a bank to identify which are the likely clients to pay back the entire amount, which are the clients who are likely not to pay back. So the risk has gone down due to technology, due to better documentation, due to regulation as well. And two, there has been a significant push from all governments. Banks are actually an enabler industry. Banks do not produce an end product like a machine or let's say like a food product. Banks are an enabler industry. Almost all governments around the world, including the government in India as well, we have almost always seen that banks have been pushed to work as a as a necessary enabler. What it means is when there has been a requirement of economic growth, or central banks face the importance of pushing more credit into the economy to fuel growth, they have always tried to bring down these interest rates to make credit cheaper. With cheaper credit, you can have higher returns on your business and have easy access to money to set up or expand your business or do your consumptions. If you, I mean, the latest example being when we have entered this COVID pandemic situation, almost all central banks in the world, including Indian RBI, has reduced the interest rates to push cheaper credit into the market to fuel growth. That's basically the push methodology to kickstart an economy. With interest rates going down, banks have faced not a crisis maybe, but banks have faced a problem of thinning margins. If you have lower margins, you're making lower revenues. If you make lower revenues, you'll always face problem in investing in new technology to sort of come up to be a front runner of digital change. You'll also face difficulty in getting the best talent in the industry to run your businesses. So that's something that banks have been facing for the last decade, or more than a decade as well, since the financial crisis. To give you an idea, unlike other industries, banking industry has been able to invest almost everywhere lesser amount of revenue on innovation related IT expenditure, which means that most banks in the world are cash strapped. They don't have enough money to completely turn around all their operations to match the digital age that we are in. This is one of the biggest mega trend that we are seeing in banking, that the industry's focus or the industry's work pattern is changing. More and couple of decades ago, it was very important to have as many branches as possible in a region or in a city or in a state to have a good banking presence. However, right now, the industry has changed in a way that it is very important to have a very good omni-channel digital presence to have your good customers onboarded on your platform. What it means is, of course, the importance of brick and mortar establishments or branches are still there. However, their usage as, let's say, a cash deposit or a cash management station has reduced because payments have moved digital. You need lesser branches to handle your cash. You need more branches to handle or to serve your customers as advisors. So that has been a significant change that we have seen in the last few years. And banks, honestly, have not been front runners like other industries to embrace this change, because banking, because it deals with other people's money, and it deals we know that a couple of banks going bust can actually bring down a recession on a world. We've seen it a decade ago. Regulators and banks themselves are I should not use the word slow, but are very cautious of any big change. What it means is, we are in this era of very low interest rate, very low margins, almost zero interest rate everywhere in the Western world, in the developed worlds. Interest rates are going significantly southwards in the emerging world as well. And banks need to embrace a significant amount of change in their operating model to make sure they're profitable. To give you a few numbers, if you guys like numbers on this structure, banks have been making almost 3.5 to 4% net interest margin a decade ago. Right now, they barely make 2 to 2.5% margin, net interest margin on as an industry. So that is a significant change. However, when we say that almost 30% margins have eroded, 30% costs have not eroded. Possibly there needs to be more investment in technology, digital disruption, more investment in upskilling staff to act more as advisors, and therefore be more cost frugal. The best banks in the world are almost working not like traditional banks. They're working like IT companies with amazing cafe style facilities as front offices. Um, a good example is ING. You may, when you have time, you may consider taking a look at ING's annual report and see how they have changed their operations over the last 7-8 years. It's a very interesting case to read. In India, there are, of course, some banks who we think are extremely frugal in and quite the innovators in the digital disruption way. Kotak Mahindra is an example. You can also consider reading through their annual reports. It is an interesting read. So that's that on the interest rate environment and its impact on how banking industry has been doing. However, on the impact of interest rate on the overall economy is always positive when interest rate goes down, with, of course, keeping in mind that inflation does not move up due to this. There's not a lot of free money chasing a lot of too little goods. That's again something that's important. However, what we can say very sort of safely right now is interest rates are going to be low for long. What we mean is, in the Western world, interest rates are going to be near zero for almost many years from now on as we revive from this crisis, and we'll have to operate in this environment and we'll have to operate in this new normal. Faraz, can we move to the next page?
Yes. Do you want me to move to the ecosystem space, Debo?
Yes, that would be very helpful. So as I was saying, that digital communities are changing banks a lot. I mean, you would be able to say, when was the last time you went to a bank to deposit cash or to take out cash? I'm 100% sure the number of times we go to banks for cash transactions are way lower than the number of times our previous generation had to go to banks, because you have digital ways of payment, you have digital ways of remittances, and banks are not the most would you prefer visiting a theater or would you prefer visiting a bank? The answer would almost always be quite simple, that you'd be more entertained at a movie theater than at a bank. Banks know this as well, and that's why banks in some of the most clever financial institutions or advanced financial institutions have started moving beyond banking in the last decade. What it means is, it does not only you don't come to a bank, but the bank comes to you in the theater. Let's say you visit a theater and you pay using Paytm. That's a Paytm teller sitting in front of you in the form of a QR code. What they do additionally is, as far as I was also saying, that banks have, because they monitor your transactions, not a negative way, they have the record of where your spends are. Do you like eating pizzas? Do you like going to pubs? Do you like visiting a movie theater? They know the pattern of your consumption. It is easy, and that's again taking us back to big data analysis, to what is now a very advanced form of what started as Excel analysis of client information. Banks now know that how are your daily care needs, entertainment needs, travel needs, real estate needs, home buying needs are spread across. Let's say when I was a student, let's 7 years ago, my prime agendas in sort of banking industry was that my pocket money would come to me from my parents seamlessly at the beginning of the month. I would be able to pay using a card at the canteen or at the movie theater, and I should be able to book tickets to fly back home or to take a train back home with the ATM card or the debit card. And it was so good to see that one bank had a card which could do all these three. Now, because a bank could do all these three, a bank card could do almost all these three, I would prefer that bank to be my preferred bank. So, and in many situations, I am pretty sure you guys also have moved your account from one bank to other because you found that for the sort of needs that you have, entertainment maybe, healthcare maybe, the bank has a specific tie-up with that institution and is offering curated services for you. Good examples of these sort of services are Amex, at times Diner, MasterCard, etc. Uh, this is the start or the beginning of the ecosystem world. What it means is banking as an industry or all industries have started to blur their boundaries. Of the, let's say, around 90 trillion global GDP, a lot of it is now not exactly or strictly aligned to what we used to call as S&P industries, a set of S&P industries. A lot of those are intermediate now. As you can see in the chart, in 2016, almost 1 to 2% of the total economy was network. However, if we move to the next chart, we will see that it is going to increase a lot in the next few years. Pioneer of this is China, where setups like Alipay, etc., WeChat, etc., have actually combined the social media ecosystem with the payment ecosystem, with the banking ecosystem, with the insurance industry. And all of these industries have come together to build a single platform which reduces your face time with a lot of one-off apps. So you don't need to go to a banking app, you don't need to go to a social media app, you don't need to go to an insurance app, you don't need to go to another app to make sure that your loan balances are doing fine. There is one single platform that helps you manage all of these. Also, what it does is, because it always has the information of your movement, it has the information of your interactions in financial system, it has the information of your payment transactions. It can curate on a real-time basis based on artificial intelligence amazing sort of deals for you. Let's say if you are in Delhi and you are near Khan Market, it suddenly shows up that, by the way, Debopriyo, there is this amazing offer on pizza that's going on in this pizzeria in Khan Market, and let's say you're a pizza fan, you walk in there. So that way it helps you. Also, what it helps you with is, in your difficult situations, let's say you need a quick bridging loan for your immediate impulse travel. It knows that you have been paying all your transaction dues. You have been your credit score is quite nice. It can always give you a quick access to a credit line that you can use based on your consumption pattern that it has tracked for many months for you. So what it does, three things. It helps you manage your complete living ecosystem. They help you sort of find exact propositions for you that would help you in your day-to-day life, and also it helps you with your financial needs. That's how an ecosystem is built. Banks in UK right now prominent banks are in UK right now have started a service which helps you not only with the mortgage to buy a house, it also helps you find a house, do the due diligence of legality, processes the paperwork for you, and then helps you with the loan as well. There are many international banks who now what they do is they not only do your international trade or transaction related processings, they also advise you on ideal products, on regulatory requirements of import and exports. They tend to be an advisor to you. what it helps you with is, it is not just your partner financial activities, it becomes sort of your guide or your advisor for your business or your personal needs. So all these industries coming together, forming a cohort, forming a network that also has the complete, as I was saying at the beginning of the discussion, that banking is an enabler industry. It does not ultimately produce a machine or clothing. As an enabler industry, this entire web of education, health, public services, digital content, etc. The interface is being managed by an app or a digital platform which is supported by this enabler industry. That is something that we feel is the future for banking industry as a whole, almost everywhere. There would be less amount of sort of cash handling, teller machine operated branches going forward. There would be more such digital based or even branch based, omni channel based, what we call is based experience centers that banks would change into. And that's one of the biggest megatrend that we expect in banking to materialize in the next few years. Faraz, why don't I bring you in now?
Yep. Thank you, Debo, for this. I just realized that we've run out of time for our session, and I was talking to Bhavna ma'am before it, and I told her it'll be a 30-minute speech, because I think beyond that it is just too long, and I just went back on my word because it was 60 minutes. We still have, I don't know if we still have time for some questions. If there are any, I'd be happy to go through a few questions.
Yes, sir, we have few questions. So here's the first question for you. The question is from one of our viewer, and the question is, what do you think about the role of the international financial institution in supporting sustainable development?
I think they have a okay. Then let's go question by question, and Debo, feel free to take up any question that you want here. The reason why I started speaking for this was because a few weeks ago I had the same discussion with other people regarding this. I think the answer is simple. The answer is tremendous. Financial services sectors stand in a very basic role. So they stand in the middle of a system which needs to change. And what I mean here is that let's take the example of energy. Banks need to bankroll windmills or give loans to companies that want to invest in clean energy. How will they do it? They will need to take a risk, and they will need to take some losses. Maybe investing in oil, and I'm not belittling any industry, I'm just stating it for the sake of example. Maybe investing in oil is a better financial deal, but it is at the same time that banks would need to recognize that their purpose currently is to further environmental sustainability, so they can make slightly less money, but they would need to invest in clean energy. It sounds far-fetched that why would they do it? But if you look at it historically, banks have been very central in promoting big change. When railroads were being built all over the world in the 1850s and 1860s, I mean, it was bonds, not banks, but still, it was extremely risky investment. And one of the reasons why this investment happened was because people were willing to buy those bonds, banks were willing to lend it out to trains, and that really led to a transport revolution. So every time such a big change happens, banks play a part. I think in this case, this particular time, it would be leading customers in a way that telling them that we are only going to invest in clean energy, even if it means less business, or finding out innovative products that help those businesses.
Okay, thank you so much, sir. There's another question, and the question is, what are the ways that are being used by the banks to counter the NPA, non-performing assets?
Yeah. So for NPA, There are two things that generally banks should do. One, it should have a very good appraisal process. What it means is, when it is not ideal to get into an NPA in the first situation. And how do you do that? It's a very stringent appraisal process. What it does, it should not mean it is lengthy. There can be a good appraisal process that can be put in place while extending the credit itself. Unfortunately, in many countries, including in India, there has been many situations where credit has been extended with due diligence that were not up to the mark. It is very important. If you are looking for a career of let's say a corporate relationship manager who would be appraising industries and giving out those huge ticket loans, it is very important to be as strong and as you should be able to say no in many situations. It is very important. It does not mean that you should not extend out any credit. It is very important to make sure that you know that the financial you can read corporate balance sheets. You can see that there's not the company has not moved money from one for what the money was given for. If there is any such indication, you should flag it at the very beginning as possible. And second important bit of managing NPA is after due diligence, after you have issued the loan, is tracking. It is very important. What is an NPA? Let's say an Indian structure, and an NPA is what has been overdue for more than 90 days. In many situations, when it becomes an NPA and your system shows that, by the way, this has now a red dot against it, it has become an NPA, 90 days have gone by, the payment has not come, you suddenly wake up. Not all banks or not all branches, you suddenly wake up as an RM and say, guys, we see that this has not, the money has not come. That should not happen. If something becomes a 30-day overdue, you should have a system. There are simple systems. All banks have such IT systems to tell you that, my friend, your client has not paid this month's EMI. You should either reach out to the client for a reminder, help him. At times there would be situations. Right now it's a situation where many big industries, the best of the best companies, are not being able to manage their cash flows. You can restructure, you can help them, you can give them moratorium, but you should be on top of your business, that yes, I know which are the accounts that have not been able to pay, and of which are the accounts which have been which have shown deliberate non-payment of EMIs. It is very important and that is something that can only be managed at RM levels. Very important to know. Of course, there can be central flagging systems. There can be systems. There can be thousands of IT systems put together by the bank. However, the frontline managers of the banking system are the most important elements on this. If you have given a loan, you should be able to take ownership for that. It does not mean you should not give out loan. The best, CEO of a bank are generally the ones who have done a lot of such sales experiences in the past. You cannot, if you can't sell well, you would never be able to grow to a very senior position. It is important. However, it is important to sell well. You should not extend credit under pressure. You should not extend credit to something which looks dubious. However, if there is a red flag which you think, or a yellow flag which you think is coming up in your mind, it is better not to do such transactions. It is also very important, especially in large industry transactions. A lot of these loans are syndicated loans. It is important to see, even if you are not the lead bank in the syndication, even if you are a smaller party, it is very important to do the entire due diligence for you as well, because ultimately at the end of the day, it is your depositors' money that you are giving out. So the first section, try not to make an NPA by giving good loans and by very thorough tracking of portfolio. And two, if you have actually, and there can be situations where NPAs have been generated, no one can do anything about that. Do flag it. There are SARFAESI, there are a number of acts in India and abroad that can be used to have a check on, to have your first demand on that company to make sure that the loan is restructured if the company can actually turn around. It is very important also to be prudent on such legal steps, so that you do it once, you are now known in the market as an RM who cannot be messed with. You ultimately, at the end of the day, for corporate RMs, it is also a bit about their own brand name. If I am an RM who can't be messed with, someone did an NPA with me, which was a deliberate NPA, and he had to go to the court and faced all the music. The next one would think 10 times before bringing me a portfolio which would be dubious. That's how you manage NPAs, my friend. You cannot. There is no 100% foolproof method of not doing NPAs.
Okay. Thank you so much, sir. There's another question. The question is, with the technology being incorporated in enhancing and accessing the financial services to all, how is the security threat being taken care of?
Sorry, it's new. It's a new threat. Banks are investing in building internet firewalls and hiring a whole bunch of new people. 30 years ago, you wouldn't have high-end coders working for a bank. Now they are. So it's a new threat, and they are evolving and they're slowly working with it. But by the way, if you look at it historically, the rates of online fraud are substantially lower than what bank robberies used to be in 1900s and 1910s and 1920s. So of course, I wouldn't say that, oh my God, banks are on top of it, but I think they're way ahead of the game that they should be. And the people at the forefront of it are payments companies. So companies like Amex, companies like MasterCard, companies like Visa, they do a couple of things. First, of course, they have wonderful coders who can identify if this is actually a security risk or not. And secondly, they also know your purchasing patterns. If I have never bought a book and suddenly my card says 5 books, they're going to flag it, and I'm going to receive a phone call from Chennai in the middle of the night that says, have you bought books? So that's how they are tackling it. The real risk is only in payments, and it's less and less on the side of money being transferred. Yeah, so that's it.
Thank you, sir. There's one more question. What are the upcoming job profiles in the financial sectors in the coming years?
Debo, do you want to take this?
In terms of employment, banking industry would now be more, as we were discussing, would be more technology focused. It would look, and there's a significant amount of talent change or talent upskilling that is either already happening in the industry or is slowly gathering pace, which would possibly reach its peak in 2021, 22, 23. The sort of talent that banks would look for are looking for are ones who understand financial technology. What it means is, you know how to read a balance sheet, you know how to do a cash flow statement, and also you are quite prudent with the technology element of it, designing the flags, as I was saying, that 30-day overdue, it gives you a flag, and also analyzing data from customer. Maybe you are a corporate RM, you know that this corporate took a huge bank loan to set up a big factory. It should be able to generate for you your model, or you should be efficient with modeling in a way that you should be able to ascertain how much cash flow, how much working capital they would need for the next maybe couple of quarters, and you reach out to the company with a proposal that I can give you this working capital limit, let's say CCOD, whatever limits, and this is what I'm going to price you for that. The second element of this is sort of on the relationship management side. And second, very and extremely important part, as we were already discussing in the previous question, is risk management. Risk is something that banks have reduced a lot in the last few years, and the way they have reduced is through predictive modeling. With now IFRS 9 being adopted across the world, where you need to provision upfront and you need to provision in anticipation of how the portfolio would move, it is very important to have such brilliant minds in your bank who can predict or model expected losses, expected provisions with significant degree of confidence and accuracy going forward. And such people would be strongly in demand. So folks who can do really good mathematics, folks who can read the balance sheets and can upskill themselves on different financial elements, and folks who are brave enough to do the right portfolios at the right time.
Okay, thank you so much, sir.
And just as a reminder,
Yes, sir.
we were talking about 2030. We are not talking about 2021. So anyone, don't get discouraged that this is going to be the jobs in 2021. We are talking about 2030.
Yeah, of course.
Thank you, sir. So the next question is, what step needs to be taken by RBI, SEBI, or IRIDA to increase their credibility so as India can still go on and borrow from the international organization so that they can fight the current pandemic?
To be very honest, RBI is one of the strongest. It used to be one of the most hawkish and one of the safest central banks around. It is regarded as one of the safest central banks around the world. RBI's and although we have many of us have a premonition that in emerging markets, central government institutions or central banks are sort of laggards in assuming technology-related stuff, in encouraging fintech disruptors. It has not been the case for India. RBI has been drafting such proposals, such working documents, inviting many new digital banks for the last many years. When it comes to borrowing from the from international markets or from, let's say, the IMFs, etc., India, of course, as a country, because it's an emerging country, would always have a higher borrowing cost due to the simple corporate finance rules of higher beta and higher risk than other countries as of now. However, if you look at our interest rate, central bank's interest rate, that has reduced significantly without inflation shooting through the stars, which still means that there is scope of our borrowing costs going down in future from international markets.
And I think just as a last bit to add one line to it, our borrowing costs go down from the international markets if our government spending is less than the government's revenue. It's like a company's balance sheet. It doesn't need to go down always because we need to spend, we need to build roads. So that's the part that the finance ministry calls the fiscal deficit, and then they manage it. It can't be a lot, it can't be too small, so it needs to be in the middle. Companies' borrowing costs depend upon a risk premium that banks apply. And the way to go down, make that go down, is to reduce risk, and that's what Debo spoke about in the previous answers. That reduces companies' borrowing costs.
Thank you so much, sir. Because of the restriction of time, we'll not be able to take further questions, but we'll definitely be mailing you rest of the questions. That was indeed a swift insight into the whole process of banking, explicated in a much comprehended manner. The takeaway from this session are definitely the three mega trends, which are, firstly, the digital disruption with its three advent forces, which are new technologies, regulation, and customers. Secondly, macroeconomic realities, that is the low interest rate emergence in China or Southeast Asia, which does have a positive impact on an economy. Thirdly, emergence of ecosystem where the banking institution has changed their overall outlook of being a part of the customer's life without the physical presence. This was perhaps a great learning experience for all of us, and on the behalf of all the participants, I would like to place on record My heartiest gratitude to Mr. Faraz Ahmad sir and Mr. Debopriyo Bhattacharyya sir for this knowledge-rich quality session. Thank you so much, sir.
Thank you for having us, and thank you for this.
Thank you, sir.